joining us on Facebook Live. We're here with this amazing group of people. Thank you for joining us for another Lunch, Learn, and Lead. Be ready, it's going to be fun. We've got some amazing guests with us and speakers today, so we're going to go over some things as far as what we've got coming up. I just want to thank y'all so very much for being here again, taking time out of y'all's crazy busy schedules, meeting all the world, and like I said, to learn something informative as well as being able to network at the same time is a win-win for everyone. So thank you for being here. Boom, this is the one I'm really excited about. This is going to be an indoor golf tournament that we have coming up at the back 9 on June 20th. If y'all haven't registered, please do so pronto. Spots are filling up quickly. What's great about this, unlike golf tournaments that are outdoors, a lot of times it's hot and you're sweaty and you're there all day and all this good stuff. You're there for 90 minutes in the AC. And then literally we will be delivering the prizes personally. So we will be giving your business, whoever the winners are, a big shout out to whenever we deliver all the prizes. Correct, Michelle?
Yes, ma'am.
Yes. And a huge thank you to our VIP sponsors on this, as well as Thrivent, who's the actual sponsor, Republic Services, presenting sponsor, Delic, and there's our friend B&L again. So y'all make sure there's printouts here to make it easy for y'all. If y'all would like to register, we would love to have y'all. Like I said, this is our first one to try this, so we're super excited about it. And we're giving the business to a very valued, accredited business, Rontez over at the back 9. So thank you, Rontez, for hosting us. Our Longview Shred Day is coming up on October 4th. The one here was absolutely amazing. 531 vehicles came through here. We shredded almost 40,000 pounds. And then we had 2 huge bins of electronics, thanks to STS, who securely disposed of those. So we're so grateful for that. If y'all didn't make that one, if anyone lives close to the Longview area, it's going to be a drug emporium. Last year we had about 220 cars come through there. So it's always a great turnout, and it's a free service. You don't find free anymore. There's always that fine print, right? So thanks to the sponsors of that. We truly appreciate it. So here's what we've got going on. This is next month. This is kind of showing y'all what they're going to be speaking on next month. So it's basically a 3-part series, and we're super excited to have the gentlemen here today, Michael and Alden. I mean, I met them at some chamber events, and just amazing, intelligent gentlemen. So we're grateful to have y'all here. Okay, so come on up, Bella. You want to introduce?
I will be happy.
And just so y'all will know, I will follow up with all of you in an email at the end of this with links on our upcoming events, so it'll make it easy for you to register or sponsor. Of course, we're always looking for sponsors. Also, we're always looking for door prize donations that will get you recognition also at the event as well, saying, thank you for doing this. So go ahead, Bella. We're so excited.
Thank you for the opportunity.
Yes.
Lavender Warr equips business leaders with data-driven strategies to make confident decisions, specializing in analytics, financial modeling, and strategic advisory. We help clients turn complexity into clear across financial, strategic, data science, real estate, private equity, and more. Our commitment to objective and initiative ensures reliable and actionable insights. A little bit about Michael. I had to remember, I messed up his name, so I'll remember. Michael Lavender founded Lavender Warr in 2015 to help Texas business harness operational financial data is the same, right? Strategic decision-making, former chief landing officer and entrepreneur. Michael is also dedicated civic leader, honored with Tyler's W.C. Windsor Award. He studied physics, psychology, finance, and data science at Texas A&M Tyler Junior College. All in, did I say it right?
That's perfect.
Also, it's all. Alden Warr brings deep experience in finance, investment, and entrepreneurship. At Lavender Warr, he guides clients through growth and complex transitions. Alden, sorry, I had to think. Previously, finance. He co-founded an AI healthcare startup and helped launch a hedge fund. He's been recognized as a top 100 healthcare leader in a Texas A&M 12 and under 12 honor.
Woo! Awesome.
Welcome. So,
Right.
so you're now filling up.
Yes,
Okay, oh, I won't need that part.
You know,
Right.
here's your slides are up there. Oh, okay.
So, the three-part series for the program that we'll be doing over the summer with the Better Business Bureau in concert with them is really something that we've noticed in the local business community that there's a bit of a gap. The short way of saying that is that we have all kinds of advisors locally, attorneys, partners, I know most of the managing partners there, accounting firms, financial advisor, mortgage specialists. You've got niche expertise in all different areas of our community to help with all the different things your business might encounter. The one piece that over the decades I noticed, going all the way back to my days in banking, is that we have all the spokes of the wheel, but there wasn't necessarily a hub. So over this series, the thing that we're going to talk about is business continuity, succession planning, transition, merger and acquisition. Every business, we've heard it said, we all are born, we all die. Every business starts, and every business either gets sold or closes. Those are your two options. Our firm really works in both areas. You've heard us say that we do financial analysis and data analytics. That's so we keep you open. What your numbers say, what your numbers tell you about your business. Those numbers are whispering at you all the time. Do you know how to listen to the whispers? And then when it comes to that season, when it's time to think about succession, how do you do that? Even if it's internal to a family, even if it is passing the business to the next generation, or if it's a third-party sale, or if it's taking on investors. And then on the flip side, or if you're buying a company, buying a competitor, buying into a new opportunity, making an investment. All of those things are heavily driven by the analytics. One thing that we say to our clients routinely is, you're the subject matter expert in the thing you do. That's not a free pass on being a subject matter expert on how to do some of the things a business needs to, right? I won't say show of hands, because we wouldn't want to take any business from the Potter firm, but how many of you would feel comfortable writing a full real estate purchase contract from scratch, not from a template, just open up Word and get it all right? You're not going to do that. You're going to reach out to your favorite attorney, corporate counsel, a real estate legal expert. Likewise, your taxes. There was probably a season where for all of y'all, like myself, I just did my own taxes with W-2. So I put that in here, put that in there, I sent it in. And I wasn't making enough money in those days for it to really matter. Even with degrees in physics and statistics and financial analysis, when I get my tax return back from my CPA, I'm like, it's good. No idea. Because did anyone say, in fact, I don't think I heard anybody say they were with a CPA firm or, but I know accounting, I heard accounting, right? I've heard it said that the tax code, current tax code, if we printed it out, I forget how many file, 6-foot tall file cabinets it would fill. I don't have time to know all that stuff.
Right.
I have to know how to do my business. You have to know how to do your business. But there are things you're going to encounter where you need expert advisors. We don't try to be attorneys. We don't try to be CPAs. Our expertise is in the numbers themselves. What is your data saying, whether it's operational data, financial data, how do you marry those two, how do you structure transactions, everything math-based. Where does that start? Understanding your numbers. So, everything you hear today, if you start having that woozy moment of like, I skipped the accounting classes in college for a reason. I do not want to know this. Yes, you do. You want to know it as much as you know every other key thing about your business. Do you have to know it like we do? No. But you need to know something about HR, management, banking, accounting. You have to know enough about all those things to know if you need to pay closer attention. So, today's presentation, again, 3-part series. This is chunk 1 Alden is our resident accounting and analytics expert.
Specialist.
He is going to walk you guys through what's most important, why, and how can you get your hands on it. Anybody in here do their books just on a yellow steno pad with a calculator? Just in your head? Okay.
Thank
goodness. So, all of your businesses are using some sort of software. It could be industry specific, where your actual CRM is keeping up with your financial information. You could be using QuickBooks, most likely, for a lot. And anybody in here, NetSuite, Peachtree, any of the, okay. That's really kind of middle market size business, 25 million in revenue. But these platforms are capturing all this data. What are you doing with it? Everything we're going to show you today, minus a couple of the more nuanced finance calculations, are going to be things that are just already in your books. We're going to make you all look smart. We're going to go back to the office. Next time there's a finance discussion, you'll be like, let me see that trailing 12 report. And here's your trailing 12 report, you're like, well, looks like EDAR is really suffering because of that investment we did. And I think if we have an interest rate reset, we can get some risk here of our quick ratio getting out of whack.
I love it.
That's right. That's right. Yeah. No, it genuinely, right? So over the years, right, I got gray hair. I've been around a minute. I've been to presentations where it's like, razzle dazzle, razzle dazzle, razzle dazzle. Here's my business card, right? Like, I'm going to show you things you can't do so that you have to call me. And we've got more than we can say great except our team's growing, so we help. We have Alden and I have realized we have a shared deficiency. Neither one of us know how to say no. Hence the business growing. But this is genuinely geared towards, man, tell me what I need to know. I'm not going to be a finance expert. I'm not calling y'all. I came here so I can learn something. That's what we want you to leave with.
Yes.
We are around, but that's not the intent. The intent, and Alden is great at this style of presentation. Tactical, practical, leave here, back at the office. Next time you see the reports, you know more than you did when you came in this morning. So,
Love it. Love it.
yeah. Alden Warr.
Thank you, Michael. That's a great intro. Thank you all for coming to today's presentation. This is an awesome full classroom. And that said, though, it's also a perfect size in that it's still pretty small. So I think ideally, especially given the range of industries that we have and the range of roles in your company, I want this to be very interactive. I don't want you to think, man, this was all like way over my head, or man, this was so high level that I was really hoping to dig deeper. So at any point, just reach out, ask me, hey, use some jargon there, use a term, what does that mean? Hey, that sounds interesting, and where that concept could we dig a little deeper. So please reach out and just shout it out. There's only 30 or so of us here, so we can have a conversation.
And don't worry, I'm over here close and listening for jargon alert. We can't help ourselves, but occasionally get into our own natural language. So I'm here to listen for jargon, and jargon. Yeah, we'll back up a little bit.
Yeah, this is a lot of fun for us accountants. We don't get asked to like DJ a lot of parties, so every now and then this is fun for us to get up and talk. So in the little packet that you have in front of you, amongst the slides for today's presentation, you also have this little mini case study. If you can go ahead and pull that up, halfway through the presentation we're going to be using this, but all through the presentation we're going to be using exhibits from this to kind of walk through examples of P&Ls and balance sheets and that kind of thing. But today, financial literacy for leaders, Michael's already done a great job talking through why this matters. Accounting is the language of business. It's not really math. Accountants don't do math beyond like the second grade level, pretty much adding, subtracting, that's about it. It's really a language. It's a how we talk about business, and for you, many of you business owners, or the people that the owners have entrusted to lead and manage their businesses, and so the ability to understand and speak that language is absolutely essential. And without that, I think that's where these kind of stats come from. The first time I heard this, it was shocking to me. And I think it's shocking to a lot of business owners. that 60% of businesses that fail, and some estimates actually have it up into the 80s, are profitable when they fail. They actually have a strong profit margin and they run out of cash. And I think that's really key because so many of the business owners we talk to only look at their P&L or they're managing out of their checkbook. And as long as I have a good 15% profit margin, I'm good to go. And the reality is the vast majority of businesses that run out of cash are in that position. And that's why we have multiple financial statements that we look at. That's why there's a balance sheet and a cash flow statement. That's why there's working capital calculations, those kind of things. They've been invented over the centuries of accounting to address that specific problem. That's what we're going to be talking about today. Additionally, so many business owners, when they get ready for that moment of succession, selling their business, handing it off to the next generation, leave tons of money on the table because in the years prior to that, they weren't paying attention to their working capital. They weren't organizing their financials in such a way as to both facilitate and present the cash flow that that business is generating, because that's what's ultimately going to be acquired, is that stream of cash. Everyone owns a business or buys a business for the stream of cash that it generates. And you need all of the financial statements and a good understanding of what they mean to properly present the value of your business. So, our objectives today, we want to learn why that first stat exists, why profit is different than cash, and how all those financial statements marry together to give you a true understanding of your business's health and the lifeblood of your business that is cash. We want to be able to read and understand all the three primary financial statements with confidence. Identify working capital levers. Working capital means if you think of a business as basically a cash amplifier machine. Cash goes in, it goes through all these steps, and then more cash comes out on the other end. Working capital is all the cash that's in your machine at any given time, between putting it in and it coming out. So we'll talk about how to calculate that and how to manage it such that you minimize the amount of time that you don't have access to your cash because it's in the machine. And then finally, we'll talk about how to build and use actual cash flow budgets and liquidity forecasts. Liquidity just means how much cash do I have. To do that, we're going to walk through the three financial statements. We're going to talk about specifically why there are differences between profit and cash, working capital essentials. That's the first half of this presentation. The first half is really reading and understanding accounting, your financials. We're going to do the case study, and then the second half is, okay, now that I know what all those terms mean and where I can find them, how do I then use them to make business decisions? Budgeting, forecasting, measures and metrics, and a few quick action items that you can take that to improve that liquidity and minimize working capital. And then hopefully leave a lot of time for Q&A too, so we can have some good conversations about how it applies to your business or your industry specifically. So, first, your three core financial statements: income statement, balance sheet, statement of cash flows. Almost everyone we talk to knows about the income statement. It's talked about most broadly. It's fairly easy to kind of get to it, or at least people perceive it that way. Broadly, you hear about the bottom line. Hey, what's your bottom line? Hey, what's your margin? That kind of thing. We'll talk about some little nuances there because some parts are misunderstood, but that's probably where most of the comfort is. Balance sheet, that's actually your snapshot of how financially healthy is your business. In a lot of companies, in a lot of industries, I would say your balance sheet is actually much more important than your income statement. Because your income statement, there's a lot of ways that can be deceiving. And your balance sheet, I mean, that is just straight up, how much cash do I have? How much is my equipment worth? How much do I owe other people? Statement of cash flows is really the bridge between the two. So your whole statement of cash flows, and we'll go through this, is starting with profit and getting to the change in cash. And where specifically did all that cash go? Again, cash is the fuel, profit is just the scorecard that helps you understand how kind of rates your business. But cash, lifeblood of the business. Income statement. So this is the first time. Go ahead and find in your case study the P&L I think it's on the back of the
Sorry, it's on the
narrative.
side,
No,
sorry.
that's perfect. So this will just be, it's a great place to take notes or make little, jot some things down as to what some of these definitions mean. Again, we won't spend a ton of time on the income statement because I feel like it's the most understood, but there are a couple of points that I do want to call out. So, of course, we start at money coming in, and then go through money leaving, and then how much is left. Functionally, that's the flow. So revenue, how much money did we make? With the caveat, and this is important, this is the first thing that I wanted to point out in our, accounting series here. Revenue is the money that the business earns from its normal business operations. And I see that mistaken often. I'll see people, so if you are a roofing company, revenue is money that you made putting roofs on buildings. It's not money that you made because you took out money from the bank. It's not money that you made because you sold a truck. It's for you as the business and your bankers and your investors to see how much is the business and its core repeatable processes making each and every month. Okay? There are other places where some of those other items will go. Cost of goods sold. Cost of goods sold and expenses are similar in that they're both money that we're spending on stuff. There are little exceptions, just like grammar rules. But primarily, think of cost of goods sold. If you're like, hey, what goes in there versus what goes in expenses? Cost of goods sold is basically if you do one more sell, does an expense go up because of that one additional sell? Or if you do one less sell, do those expenses go down a little bit? If so, probably cost of goods sold. And if you had a month that was absolutely zero revenue, like, whew, we just goose egged that month. Well, actually zero. We sold $0, which is unlikely. But if you like, hey, I'm gonna go to Europe for a month, and we didn't sell a single thing, then your cost of goods sold should also be zero. And that's a good way to determine too if something is an expense or cost of goods sold. If you don't sell anything, there's no cost of goods sold.
You wanna give some practical examples maybe
Yeah.
from the case?
And that's a good, so if you see here, it's broken out to a couple of common areas. This case is a furniture manufacturer, so raw materials, hourly labor that's only engaged in building the thing. Those kinds of things would be the most common kind of cost of goods sold. Expenses are those items that they're within a range going to be basically functionally similar month to month. If you sold 10% more in a month, they probably don't change. Now, of course, if you triple your business, then maybe you need a bigger facility, maybe you need to hire people, that kind of thing. But that's not really what we're talking about. Incremental changes, if it's vaguely, broadly similar, expense, payroll, marketing, rent, that kind of thing. So, revenue, cost of goods sold. With that, after that, you have what's called your gross profit, or your gross margin. You hear talk about that a lot. That's basically how much is left over to cover all my overhead expenses. That's going to be super important when we think about break even and how much sales then how many roofs do I have to put on in order to cover all my marketing, my payroll, and my rent. Gross margin is going to be key for that. Expenses, of course, all that we talked about, and that leaves you down. We're going to spend a little bit, the whole next slide, talking about EBITDA and why that's important. But functionally, that takes you down to operating expense, or operating income. As an operations, again, in the regular, ongoing path of my business, how much profit did I make? And then you have where you put all your other stuff. I sold a truck. I bought a truck. Well, bought a truck instead. I sold a truck. And then that leads you down to your final net income, your bottom line. So, I mentioned we talked about EBITDA. EBITDA, and I'm actually going to spend a little bit of time here, because EBITDA is an interesting little animal, and if you've ever taken out a loan, if you've ever bought a business, if you've taken investors, that kind of thing, you've probably heard the term EBITDA, because a lot of people like to talk about it. But from our understanding, a lot of the business owners that we work with, don't have a strong grasp of exactly what it means or how to calculate it themselves. So if we back up, EBITDA is actually a relatively new term. EBITDA was only invented in the 70s, which is kind of funny. You don't think of like profit being invented. But EBITDA was invented in the 70s by a gentleman named John Malone, who's a cable entrepreneur, because his investors kept giving him, kept hassling him over, John, your business is not making any money. And he's like, it's making a ton of money. What are you talking about? But he was fast growing. He was investing a lot in equipment. He was depreciating that equipment, even though it was on a note or something at the bank. So the cash was still there, but it showed as a big expense. He was borrowing a lot of money, so his interest expenses were high. But he's like, but that's just a choice that I'm making to manage my cash. So he's like, man, I have to figure out a way to tell all my investors and my bankers and everyone else that this business is really a cash machine, even though it shows that I'm actually not making much money. So he invented what's called EBITDA. He's like, I want to show them what my earnings are before my interest, that's just a choice that I'm making to fund my business that way. My taxes, because that has nothing to do with how I'm running my business, that's just the government. And depreciation and amortization, which are accounting expenses that don't have any cash associated with them. You don't ever write a check to depreciation. It's just an accounting measure, and an important one, but an accounting measure to help you understand that, hey, there is a real expense associated with your big capital investments that you have to do, so it just keeps it in your mind that, like, hey, my equipment has its expense, even if it jumped over on my balance sheet. So it's important, but he's like, but especially when I accelerate it and that kind of thing, it looks like I'm not making money, and the cash flow's there. So I think that story helps business owners and business leaders understand why it ever came up, because it resonates with a lot of people. Of like, yeah, none of this matters. It's how much money I'm making, which is a lot of the point of this conversation, and that's what EBITDA is supposed to get at. It's a rough kind of guess at free cash flow for your business, because it takes out all these non-cash expenses. Does that make sense? Mm-hmm. So, who cares? Bankers care because of the same reason that John Malone came up with it. They want to know what's your ability to pay me back, and your interest is going to change based on that loan. That's something that they're going to calculate. They don't care about the non-cash stuff, etc. Specifically, this actually really came to prominence because of debt. After John Malone came up with it, private equity companies took it and they're like, this is amazing, we love this. Because they were using a lot of debt, they were growing fast, they were in a similar position, and then it kind of moved from private equity over to banking. So investors, potential buyers, all those love it because they basically came up with it and proliferated that. But then we have that last line here, and that's really supposed to represent you, the business owner, whatever business and name, because we all should care about EBITDA, because like I said, it's the shortcut to broadly how much cash is the operations of my business, aside from taxes and interest and non-cash expenses, how much cash is it generating? But, do you have something to say?
I want to add something real quick. Former banker, right? Show of hands, who's actively selling their business right now? Who's actively buying a business right now? Okay? Who has a business loan in any way, shape, or form? Okay. You're most likely, when considering the who cares, need to know this for your bank. You'll hear EBITDA, debt service coverage. So think about this calculation. If you want your banker to say, they're on it, because remember in banking, it's as much about who you're lending to as it is the numbers. Bankers want to know that you know. And I meant to say this at the very beginning of our session here. The reason I left banking was that after 15 years, I've made my way to chief lending officer. I had the career, right? Except I didn't like golf, which made me kind of a weird banker. But all that said, business owners came in all the time, business leaders came in all the time, and they would sit down and everything's just phenomenal. It's going great. and I would start asking what to me as a banker were very simple financial questions. And the business owners either didn't know or couldn't speak with any kind of precision. That was always a starting challenge, and ultimately, to make that story extremely short, the day I walked out of the bank, it was to step to the other side of the equation and make sure that business owners could speak that language, could go in and talk, and did know their numbers, because there's a reason banks use that one figure as kind of it's the heavy crowbar of whether or not they do or don't work with you. It's the biggest calculation of all calculations in their considerations. There's plenty of others, but I just realized if business owners don't think in that same language, and not that you have to, right? You're trying to figure out how to get the jobs done. Where are my people? Where do I have the materials? Did I get paid on that? But this has to be in your repertoire. The reason we put bankers at the top of the list, it's the most likely time that you're going to encounter this. So think what you start with. You start with your P&L, you go to the bottom line, that net income number. And then you, before, add back any interest expense you paid, right? Because as Alden said, that's optional. If I owned the business and I had just excess cash, I wouldn't have had that interest expense, right? I wouldn't have borrowed a loan. So we want to add that back in. Taxes, what's your tax bill on zero profit? Zero.
Yeah.
So taxes only show up if you made money. So that's a good thing. So we want to add that back.
Can I
Yes,
mention
go
something
ahead.
real quick on taxes, because it's super common
Yes.
misconception for small business owners who are generally LLCs and pass-through entities. This is only income tax, federal income tax. Corporate federal income tax. It's not your personal tax, it's not property tax, it's not ad valorem tax, it's not
Sales tax.
Those are real business expenses that don't get to be added back. Corporate federal income
If you're a
tax.
C corporation.
Yeah, so most businesses in here probably don't have anything to add back for taxes.
And then, as Alden said, you don't write checks to depreciation or amortization, so we add those numbers back. Then we get to that EBITDA number. Then what does the banker do with it? The banker sees how many dollars those are, and they do the debt service coverage ratio, right? EBITDA, DSCR, right? You're looking to see, I've got that number. This business is, with all those added back, making $200,000 a year. I'm then going to take the interest number back and put it in the equation, but in a different place. How many times, you hear about coverage, right? It's a 2 times coverage. Our bank policy is you've got to have a 1.25 coverage. What? Like I need a tar for where do I live? But that coverage is, I've got 200,000. Is that more than 1.25, 1.25, more than how much I'm going to have to pay the bank this year in principal payments and interest? So it's a $5,000 a month payment. It's like, okay, 5,000 times 12, because that's principal and interest, 60,000. This borrower has 200,000 in EBITDA to pay me back 60,000. We're good.
Yeah.
We've got more than a 2-time coverage. That's very comfortable. That's very healthy. There's plenty of extra left. Because remember, the very top one of their earnings is after you paid all the expenses. It's the bottom line of the net income. So this is what's left to pay the bank, to then later pass it through, pay your taxes, to do your accounting stuff and take depreciation and amortization. The sole crowbar for most banks, debt service coverage based off EBITDA. So if they care, you care.
Yes, yeah.
Thank you for that.
Yeah, absolutely. And I'm gonna grab a water too.
Yes.
The only thing, and I would just, this is gonna, at the risk of being a little confusing, I feel like it's meaningful to say, EBITDA, as important as it is, for all the reasons that we mentioned, the little asterisk I would put with it is depreciation is there for a reason. It was invented because it does cost money to redo your capital equipment and that kind of thing. And so depreciation helps you keep that in mind and not overspend, because you're gonna have to replace that stuff that you're depreciating later. You do have to pay interest. That is a real expense. So it's important to keep that in mind too. some of we can go so far into like focusing on your EBITDA that we can forget that this stuff is real too, and it is important and it exists for a reason.
Is it fair to say this? If you can get your EBITDA where it needs to be, then you have the opportunity to focus on all the other things. Because it is the measure of cash flow. So then you have that opportunity for all the other things that we'll cover to say, all right, I've got good cash flow, but now how's that playing out?
Yeah. It's just important to keep everything in mind.
Correct.
Everything here is kind of the point of this conversation, really, is understanding all your statements so that you can take everything to paint a full financial picture of your business. The late great investor Charlie Munger famously said, you know what I hear when I hear EBITDA? Bullshit. Because it's also easy to manipulate this. And there are real expenses in here that a business owner should be considering. So it's an important tool, it's not the only thing to look at. And that's just, I wanted to kind of bring that full circle of important to know it, important to understand it, also important to take it in context of your net income and your interest and all those things. Okay, balance sheet. How are we doing so far as like,
You got a question?
yes.
Can you briefly explain amortization? I understand like in the loan world, but an interest.
It means something totally different in this context and in the
Okay.
loan world. Yeah, thank you for bringing that up because it's not like your principal on your loan. So amortization is a synonym really for depreciation, but in a very specific scenario. So if you buy, this is by far the most common use of amortization. If you buy a business, say you buy a competitor for $1 million, and you add up all of the hard, real assets that you bought with that business, the equipment and the inventory and that kind of thing, and it adds up to $300,000. Most of the time you buy it for some meaningfully above the actual equipment value. That $700,000 difference we call goodwill. That's kind of how it goes into that. And goodwill is amortized, not depreciated. So basically, that's I think 15 years, but I have to double check that. It's a tax standard. But yes, so I think it's 15 years. Double check me on that. But basically, amortization in this context is just the method by which you depreciate non-physical things like goodwill.
Which is like customer lists and.
Exactly, customer list, brand name, because usually you end up buying a business based off of some multiple of cash flow, and then you kind of have to back it into its value for all the equipment and that kind of thing, and you just put all the intangibles into that, goodwill, customer, brand, that kind of thing. And so those are the things that you amortize instead of depreciate.
So you take 700,000, divide it by 15, if 15 is the number, and that's what you put in
Every year.
every year.
That's right.
Okay, thank you.
Yep, great question. Okay. How are we doing on time?
We got about 15. I like trying to leave 5 at the end.
Okay, we'll move quickly. Balance sheet. The accounting equation on your 10 minutes into your first day of accounting class, as soon as you sit down, you're supposed to write the accounting equation on the board. Assets equals liability plus equity. So your assets, the things that either money or things that can turn into money, always has to equal or balance your liabilities, money that you owe to other people, and your equity. That's why it's called a balance sheet. Those two sides always have to balance, which also means that liabilities minus assets equals equity, if you just kind of do the algebra there. So that's pretty straightforward. The only component that I add to that is you'll also see on your little balance sheet here, or any other balance sheet that you look at, current and non-current. Both assets and liabilities are separated into current or non-current. Super simple. That just means within a year, longer than a year. So assets, we think that this is either cash right now or will turn into cash in less than a year, current. Longer than a year, i.e. equipment that you're going to use for a long time, building that you own, whatever, like, yeah, that has value to it. I can sell it, turn it into cash, but I probably won't do it within this year. Non-current. Liability, same thing. I owe that money in a year or less. Accounts payable, credit cards, those kinds of things. A 1-year line of credit. Current. Long-term, 20-year term bank note, non-current. So current, non-current. Yes.
Looking at your liabilities, you've got $100K under revolving line of credit.
Yes.
Is that the total amount available or total amount used?
Use. Yep. So line of credit, you would put the total amount drawn that you currently owe, and it always, and this is confusing, but technically always a current liability, because usually those are revolving on a 1-year basis, and although you may have had that line of credit for 20 years, technically, the bank could say, we're not renewing that this year, and you have to pony up and be able to pay that. And so that's why it actually always is in the current liability bucket.
So if you don't use it, if it's just as a backup, you just...
As a backup, it doesn't show up. Yep, there's no place on the balance sheet that you have to put that there's 80,000 unused. Yep. Cash flow statement, like I said, bridges the gap. So you start with your net income. In this case, 150,000. So in this case study, she made 150,000, but then she looked and said, but I lost $40,000. What happened? And your cash flow statement is where all the cash went positive and negative. So it's in 3 categories: operating, investing, financing. So first, you look at your non-cash expenses, depreciation, amortization, things that we're looking at, and you kind of walk through this. We'll spend more time on this in the actual case study because it's easier to talk through it with the numbers. And then finally, working capital. This isn't a statement in and of itself, but it's the main thing that we're talking about. It's the cash that's in the money-making machine that is your business at any given time. And it bridges all those together. It uses balance sheet stuff, it uses income statement stuff, but your working capital, definitionally, if you're like, well, how much is it right now? Someone's like, hey, how much working capital do you need to keep at any given time? It's your current assets, stuff that is cash or returning cash in a year, minus your current liabilities, stuff that I owe to people in a year or less. That difference is considered your working capital. And a lot of times you'll see people get working capital lines of credit in order to cover that delta, because for a lot of businesses, it goes, instead of revenue and then your expenses and then you have some profit left over, this is where that stat comes from at the beginning of the presentation. For most businesses, the expenses come first, and then sometime later you get the cash for that thing you finally sold. But you had to buy the materials, you had to pay the people, you had to do everything. And then 60 days on terms after you made that sell, you finally get paid.
The P&L is upside down.
Yeah.
For most your expenses first,
Yeah.
then somewhere you get paid.
Some businesses have the beauty to actually have negative net working capital because they get paid first, and then they have to provide the service. Netflix is a good example of that. You pay your subscription fee, and that actually, they get the money, and then they have to provide you the service. But most businesses, especially in physical products, you're going to have a huge, especially if you're growing, a huge working capital balance. And that's where a lot of the work comes in. That cash conversion cycle, basically the same thing. How long does it take to go from cash to cash through that machine? You calculate that by accounts receivable days, which is how many days on average are people taking to pay me. And that's a calculation. It's on the cheat sheet in the back of your packet, the actual calculation there. Plus inventory days. On average, how many days am I keeping inventory, or how many days of inventory am I keeping on hand? Minus AP days. How long is it, am I, on average, holding my bills before I pay my vendors? And that equals what's considered your cash conversion cycle. In general, Because basically it's thinking, I made the sell. How long is it between when I had to buy the inventory plus when I got paid, minus the period of time that I actually was able to keep the money before I paid the bills for that. So you can kind of almost imagine on a spectrum of like the longest, and then, okay, but my vendors gave me a 30-day term, so I got to take some of that off. That's your cash conversion cycle. Okay, so this mini case, and we'll move through this faster than I intended, but it's an interesting process to maybe even walk through with some of your team members and your ownership group if they're not here, because it resonates with a lot of business owners. It's a custom furniture manufacturer who had a great year, landed some big corporate clients, is just blowing and going, was thrilled, got their P&L, made $150,000 this year. That's more than she's ever made. But then she looked and her line of credit's almost maxed out. She lost $40,000 in cash between the beginning of the year and the end of the year. And she's thinking, what happened? Like, is someone stealing from me? Like, where did the cash go? And this exercise is looking at all those statements like we're doing and figuring it out. And the cash flow statement is basically your decoder rate.
Can you explain where you say the net decrease in cash of 40K? Is
Yeah.
that just because of the timing between the AP coming in and AR coming in and AP going out?
So it's all of the above. So go ahead and go to the statement of cash flow. So we're going to cut straight to the decoder rate. So you'll see at the very top, $150,000 in net profit. She's like, man, we killed it this year. Okay, but, well, and then, hey, and that is after depreciation, which I didn't even have to write a check to. So really, $180,000, and that's that first $30,000 there that you get to add back, because it goes both ways. Oh, but my accounts receivable increased by $200,000. So of the $150,000, or of the $2.5 million, I think, in sales, because these big corporate clients and they're holding my cash longer, from the beginning, accounts receivable balance to the end, it's $200,000 more now. Well, that's $200,000 that you sold that was in your revenue that hasn't showed up in cash yet. So that's a decrease in cash. Increase in assets means a decrease in cash. Increase in receivables, inventory, anything on that side of the balance sheet, if that increases, cash decreases. Liabilities is the opposite. When you see any liability increase, cash increases with that liability because it's stuff that you expensed, that you owe to someone, but you haven't paid it yet. So that's an increase to cash on your cash flow statement. So we increased accounts receivable. We got so excited about how much we were selling that we went and bought up all kinds of inventory because the business is going to the moon. So now our inventory is $180,000 more. That's it. That's a use of cash. That cash is sitting out there in the inventory yard. It's not in our bank account anymore. So that's $180,000. We also increased accounts payable because we increased our terms. We're doing more business. So our accounts payable is $40,000 higher. Well, that's an increase of cash because that's cash. That's someone else's accounts receivable. You know, on someone else's books, that's their accounts receivable. But we're holding what is effectively a interest-free loan from our vendor of $40,000. Accounts payable is awesome. We have so many business owners that just like try to get rid of their AP as fast as they can. Don't hurt your vendor relationships, but AP is just an interest-free loan. So increase in AP, increase cash.
So they would benefit from charging interest on anything over 30 days if they're a net 30 invoice.
Exactly. So that's when we talk about levers to manage your working capital. Charge late fees to accelerate that. Maybe even consider giving discounts for early pay. Say like, hey, we'll give you 5% off if you pay within the first 5 days. Or something like that, because that's a calculable expense, especially if you have a line of credit that you're paying 8% interest on. Give a 5% discount for early pay. And it's not quite that simple because annualizing and all these things, but you can calculate the amount where you're making money by giving customers discounts and not paying the bank interest on your line of credit. So early pay discounts, late fees, interest on late payments, that kind of thing, huge.
We started
Accelerate
doing
that cash
late
flow.
fees this year.
Yeah.
And it's made a huge difference.
Absolutely, absolutely. Because everyone who understands their net working capital cycle is going to hold their payables as long as they can, and they're going to, extend. So anyway, your receivables are going to get extended as they're holding their payables. And then similar to, we had to expand our machinery, so we bought a piece of equipment. That's a use of cash. That doesn't show up on your P&L. That just shows up on your balance sheet. So that's a piece of equipment. You have to capitalize that, which just means you put it on your balance sheet instead of your P&L. So that's a decrease in cash from what your net income said, because you had to pay for that. And you can kind of go down the line, a positive or negative on everything. Yeah.
On that 120, did she pay cash for that, or what if she financed it?
Great question, because she didn't pay cash for that.
Okay.
So the pairing of that, and this is where it comes investing and financing. So investing activities, she paid $120,000 for this machine. That's investing in her business. But then you can see $100,000 on proceeds from a term loan. That's probably the loan she used to buy that $120,000 machine. So she probably paid $20,000 down and borrowed $100,000 from the bank. So net, there's a $20,000 decrease in cash. So you can go line by line down the whole thing, positive, negative, positive, negative, positive, negative. And at the end of the day, after, it's not just for receivables, it's not just for payables, it's everything, loans. But at the end of the day, it's like, oh, well, okay, that's where the money went. And tremendously important statement for a business owner to keep an eye on. Because you can see and get a sense of, hey, am I always on the losing side of this whole receivables payables thing? Am I always, the one who's having to pay for that? Am I investing too much in equipment? Should I be doing more with the bank to finance some of that? Because even though my profit looks amazing, like, oh, making $150,000 a year, of course I should just pay cash for that. Well, your cash, because of your net working cycle, your cash is actually pretty tight. So you should consider, spreading that out. Those kinds of things, that's why this is so important. So
let me add that, and I'll be brief because I know we're working through this as quick as we can. But this is most critical when a business is growing rapidly. Remember that stat? The analogy I always use is like an airplane, right? As it tilts the nose up, you have to apply more fuel. One of my other catchphrases is growing babies eat food, growing businesses eat cash. The most extreme example I ever saw that, a company that for years, over a decade, their sales were about $2 million a year. And then I'm going to run off just 3 years. We want to take it all the way to the conclusion. So 2, 7, 13, 34 million. That plane was like this. In about year 2, the owners were like, you guys have to get down here. Something's way wrong. We show up, all I mentioned this earlier, somebody's stealing from us. We're like, okay, let's dig in. They're like, look at this P&L. This past year, we made $6.5 million. Profit, $6.5 million. Bank account at the beginning of the year was like 1.75. Bank account at the end of the year was like 1.2. They're stealing. It's like, all right, let's go over to this window. I said, what's all that stuff out there? Like, well, that's our raw material. I was like, how much do you think is out there? Like, oh, about $6.5 million. I was like, okay. How much was out there? How much was out there last year? The same time. They were like, oh, we probably had about $1 million. I was like, there's 5 of it. Okay. So we're gonna add that back to your cash. And it's just growth. As a banker, I watched growth kill companies. You have to know this stuff.
yeah. And it is not that growth will. It's the growth without managing your cash.
Correct.
And there are all kinds of bank instruments and investor opportunities and different things to manage that. You just have to be aware that it's happening, right? So now we're into the how to use it. All right, so the first thing that I would love for everyone to walk away with, and this is a great place for questions after, questions now, because I want everyone to understand this well. Budgeting and forecasting for cash, for liquidity. So you start with your old-fashioned P&L forecast, P&L budget. Hopefully you're doing this. A lot of people aren't, so if we're not, start with that. But it's fairly simple. Take your revenue, kind of extend it out on some growth rate, like, oh, we're going to grow at 5% this year or something. Cool. Keep your gross margin probably constant, and so that's how you calculate your cost of goods sold. Just consider they're going to be the same proportion of revenue as it used to be. So, and then your expenses probably going to be largely the same. But forecast. But then this is the part that almost no one does. Layer in your balance sheet moves. So if you have people that pay on 60-day terms, take your revenue from a month and go ahead and move that out in your Excel spreadsheet 2 months over, and that's when that cash from that's going to happen. Your accounts payable. You have expenses, but they're on 30-day terms. So you can take your operating expenses, move that one column over in Excel, and that's when your operating expenses are going to get paid. Or split it out in the proportion that it's going to. You got to pay your people right then, but you can pay for your materials 1 month later. So you kind of, for your business, you can figure out, okay, when relative to that month in that Excel column as it goes out month, is that cash actually going to either come or be due? And so you can set it up that way. And then a lot of our business owners say, oh, I want to give a mid-year performance-based bonus for my team. I want to make sure that I have enough to buy this piece of equipment that I know we're going to need at the end of next year. Should I accrue for that? Do I need to open up a new bank account until I put money over there? All that's probably going to be overly restrictive, but what you can do in this cash budget is right below that balance sheet section, throw in a little part that are just buckets that you have filling up. It's all in one bank account, but on this spreadsheet, you can see those buckets filling up toward your goals, and you don't have to worry about liabilities and accruing or actually shifting money around in your bank accounts because you needed that money or whatever. You just take it out of your bucket on the Excel spreadsheet. So that's how I recommend doing that. And then, of course, compare your actuals to it month after month and see how you're tracking. So this is like a 12-month, 18-month kind of outlook. Additionally, we recommend doing a 13-week cash forecast. So this is weekly instead of monthly. And this is very tangibly, I sold $1 million of stuff to XYZ company. They're receivable. They're supposed to pay me in 4 weeks. And in that 4th week, boom, you put that cash money in. And you layer in all your sales, when they're supposed to come in, and all your bills, when they're supposed to go out. And really get a good just over or right around 3 month, quick math, look on what should my cash balance be every week? And am I going to have a little period, a month and a half into this, where by no fault of business performance, stuff just gets kind of out of whack because everyone's supposed to pay me 2 months from now, and I've got a big bill coming up in a month and a half. And if so, 6 weeks ahead of time, I can start managing for that and call my banker and just say, your banker's going to be super impressed that you're like, hey, in 6 weeks, this is the situation. I only need the money for a few days, you'd expect a draw on that line to come, that kind of thing, and they're going to, yeah, right. Because you're going to be in one of the most informed business owner conversations they will have had that week. Instead of, hey, funny story, I'm out of money.
Yeah.
So, which is usually the conversation that we're having. And then finally, so again, this is how to use it. These are all terms and measures that you can pull out specific numbers from those statements that we just walked through to understand different parts about your business. And again, all of these, except for I think maybe inventory days, I made the cheat sheet before I decided to add that. But you can write it in. All these equations are on your little cheat sheet in your packet. Current ratio, current assets divided by current liabilities. If it's above 1, then you have at least $1 coming in for every dollar that you're going to owe pretty soon. So that's all your current, your inventory, your AR, and your actual cash. Quick ratio is just a little bit more stringent. It takes inventory away, because what if you have trouble selling it, or you have to sell it at a discount, or that kind of thing. So it's just AR cash. It is stuff that people have promised to pay me already, or that I have. And does that cover all of my current liabilities? As a reference point, we like to see people with a current ratio above 2, or 2 to 1. I have 2 assets for every 1 liability, current, and a quick ratio of at least 1 to 1.
And Mindy said at $2 worth of assets for every dollar worth of liability.
Yeah. All in
Have
that.
twice as many dollars in assets as liabilities, or at least $1 for every dollar.
Yeah. That's kind of a good benchmark goal. AR days and AP days. Again, how long is stuff sitting out there, either that I owe or that people owe me? The quick way to calculate that, instead of just actually averaging out everyone's AR, is the average amount of AR that you have at that moment in time, or in that moment in time, divided by your sales, times 365. So, 100,000 in accounts receivable, but over that period, say a year. On average, in that year, I held $100,000 in receivables generally, and I did $1 million in sales.
How do you handle bad debt in that scenario? Like we've had a customer refuse to pay or whatever. How do you account for that?
So you're going to want to try to remove that from your accounts receivable, and you actually put it on your P&L as an expense. So it's a bad debt expense is literally what it's called. And that's how you write off bad debt. You're taking it out of your receivables, it's called writing it off. Take it out of your receivables and put it as a loss on your balance sheet, or on your P&L.
So informative. Wow.
So-
My eyes are rolled back over here.
And so anyway, like AR, that 100,000 made $1 million, so 100,000, $1 million, 10%, times the period, which is a year in this case, 365 days, 10% of 365, on average, I'm holding 36 days worth of receivables at any given time. And if your terms are 30, then it's time to look and see, okay, well, people are stretching me just a little bit, so maybe I need to focus on that. AP is the same thing, but instead of revenue, it's cost of goods sold, because it's your bills out, so it's your expense side of that. So instead of revenue, it's cost of goods sold. Inventory, same thing with cost of goods sold, but inventory is the numerator of that fraction. And then break-even calculations. I know I'm probably running out of time, so feel free to just leave. But break-even, this is important, I think, because it's something that I see business owners without a background in accounting struggling with. And it's when I'm pricing stuff, how do I figure out how much I need to price stuff to make sure that I am going to be able to cover all this overhead, my payroll and my rent and that kind of thing. So they try to figure out how to divide all that into some thing that they can throw onto cost of goods sold, so that they know that it's all going to flow through. Of course, the challenge with that, because really they're trying to get to, I need to make sure that my sales are high enough to cover everything. The challenge with that, of course, is if you have $100,000 in overhead for a month, and you plan on selling 10 big things that month, you sell big contracts, and so you take your overhead and you divide that by the amount that you expect to sell, 10,000, or whatever, and so you price it at that, then, and you don't sell that much, then it doesn't help you, really. You're still short. And if you sold more than that, well, you priced it, you have left over, that's great, but you may have priced it too high and left money on the table, because you could have actually allocated less overhead to each of those sales. So that's why that method is challenging. It's not bad, but it has its downfall or its drawbacks. Break-even calculation, and the calculations are in the cheat sheet as well, is by dollars and by units, calculating how, for this setup, for my fixed expenses and my whatever, this is how many units or how many dollars I have to sell this quarter to break even. And so you're not trying to like pull stuff up into cost of goods sold artificially. You're just, it actually helps you communicate to your sales team or yourself or whoever, we have to sell 10 units to break even. If we sell 20 units, then we're X above break even, that kind of thing. So I recommend looking and using those calculations to plan and project and set sales goals, rather than going the other way around. And then finally, methods of analysis. All of those things are best used over time and relative to some number. So your current ratio is cool. It's even cooler month over month, year over year. How am I, is it going up generally? Is it going down generally? Instead of just one alarm bell going off, you can see like, it's still well above that 2-to-1 thing that guy at BBB talked about. But man, it used to be 5-to-1, now it's 2-to-1 in like a few months. Is that something that I need to, really look at before it gets bad? If your business is very seasonal, then you probably want to compare this month to the same month last year. If your business is not, then you can kind of do just February versus March versus April, etc. And then common size, what that means, that's a term that you may or may not be familiar with, but common size just means usually it's relative to revenue. So sometimes it's like, well, I don't know, like my expenses went up, is that a problem? Well, not if your revenue doubled and your expenses went up by 15%. So common size is like you set payroll or rent or something like that as a percent of revenue. And so you can compare over time, but instead of by the absolute dollar value, it's payroll is 15% of revenue, 12% of revenue, 20% of revenue, that kind of thing. So it takes out the noise of big revenue months, revenue months, especially if you're doing a long period of time, like annual trend over 5 years, and you've grown a lot. There's just almost no way to compare, like, am I paying too much or too little for payroll, except for comparing it back to that item that's changed, which is revenue. Does that make sense?
Yeah.
Great. So that's called common size, if you hear that term. That's all that means, percent of revenue. We've already talked about a lot of this. These are just a couple little quick ideas, takeaways, that's there in your slides, things that to kind of increase liquidity and allow that to move quickly. And so I do want to leave, I don't know, we probably didn't really have questions. But if you have questions, Michael and I can hang around.
That's what I was gonna ask, do y'all mind hanging out for any of you that would like to stay after and ask more questions?
Also, Rochelle also sends you guys a follow-up, and they will be copied in that
Yeah.
email, so y'all can continue the conversation. Alden, do you want to give a little commercial for what's coming next month?
Yes. So the next step is called data to decisions. So that includes your financial data, but we're going to break even further from that. So it's almost the first stage of that, of your business, especially now because we live in such a virtual world, is almost by default through your ERP systems and your inventory tracking systems and that kind of thing, capturing an enormous amount of data, and all that data tells stories, gives you warnings, shows you opportunities. And so next session in about a month, we're going to be breaking down how to capture that data, how to make sure it's clean, and then how to use that data effectively to make decisions down the road and optimize your business.
So good.
And I'll send that direct link and that follow-up email so that y'all can just click on it and register for next month for sure. Yay!
Awesome.
Tell me
Thank you
about
guys so much.
We got a little together for y'all real quick. We just wanted to give y'all, these are so awesome little smart notebooks, and it has the BBB logo on it, of course.
Thank you.
Michelle bought these, and I think
Thank
that's
you.
such a wonderful gift. And like I said, and then next, I love it. So one moment, where are we going? Okay. We just have a little, we try to end with a little trivia, and being that this is National appreciate your service. Whoever wants to raise their hand first, give me the correct answer on which branch of the U.S. Armed Forces is the oldest, established in 1775. Oh man, y'all are gonna make me pick. I'm like,
Your turn. Say Army.
good job.
Good job.
Yes, good job. There's some goodies.
10-year veteran, so.
I love it. Thank you for your
Thank you.
service.
Yeah.
That's why I said thank y'all so much. Like I said, we would love for y'all to stay after if you would like. We can't wait. I'm telling y'all right now, I'm just like, wow.